Right now, something extremely unusual is happening in the global silver market, and almost no one in mainstream financial media is talking about it. At this very moment, silver is trading at two completely different prices depending on where you look. In New York, on the COMEX Futures Exchange, silver has been hovering around the mid-$20 range per ounce. But in Shanghai's physical silver market, prices have surged dramatically higher, at times implying silver values close to $38 to $40 per ounce. That creates a price gap approaching $14 per ounce, a massive divergence for a globally traded commodity that normally stays tightly aligned across exchanges. In efficient markets, price differences like this usually disappear within minutes because traders step in and arbitrage the gap. They buy the cheaper silver in one market and sell the more expensive silver in another, locking in profit while pushing prices back into alignment. But in this case, the gap has not closed. In fact, the difference has persisted long enough to make analysts question whether the silver market itself may be undergoing a structural shift. For decades, the global price of silver has largely been determined by futures markets in New York and London, where enormous volumes of financial contracts trade every day. But Shanghai's silver market is more directly tied to physical metal demand, especially from China's manufacturing sector. So when Shanghai begins paying dramatically higher prices for silver, it raises an uncomfortable question for investors and traders alike. Is the Western futures market still accurately reflecting the true value of physical silver? Or are we seeing the early signs of a deeper imbalance between financial pricing mechanisms and real-world metal demand? At first glance, a price difference between two commodity exchanges might seem like a niche issue only relevant to professional traders. But the reality is that silver sits at the center of multiple industries that touch nearly every part of the global economy. Silver is not just a precious metal used for coins and investment bars. It is also one of the most critical industrial metals on the planet. Modern electronics rely on silver's unmatched electrical conductivity. Solar panels require silver for photovoltaic cells. Electric vehicles, medical devices, and advanced computing components all depend on silver as a key input material. Because of this dual role as both a monetary asset and an industrial commodity, silver often acts as a bridge between financial markets and the real economy. When silver prices behave strangely, it can signal deeper disruptions within supply chains or financial systems. If the price gap between Shanghai and New York reflects real physical scarcity, it could indicate that global silver supply is becoming tighter than markets currently realize. That would have implications for manufacturing costs, renewable energy expansion, and even technological development. On the financial side, silver has historically played an important role as a store of value during periods of monetary instability. Investors often turn to precious metals when inflation rises or when confidence in currencies begins to weaken. So when the price of silver starts diverging across major financial centers, it may reflect shifting global demand for hard assets. In other words, this isn't just about metal traders arguing over price charts. It's about whether the world's commodity pricing system is accurately reflecting real economic conditions. The current silver price gap didn't appear overnight. Instead, it began quietly building over several weeks as traders noticed unusual movements between the Shanghai Futures Exchange and the COMEX market in New York. While COMEX prices remained relatively stable in the mid-$20 range, Shanghai silver contracts began climbing higher and higher. At first, the difference was modest, perhaps $1 or $2 per ounce, but soon the spread widened dramatically. By some estimates, the Shanghai market was pricing silver more than $10 above COMEX levels, and at certain points the implied difference reached nearly $14 per ounce. In global commodity markets, differences like that rarely last long because arbitrage traders normally close the gap. If silver is cheaper in New York, traders should buy COMEX silver and ship it to Asia, where it can be sold for a higher price. That process usually restores balance between markets. But this time, something unusual happened. The arbitrage mechanism that normally links global markets seemed to stall. Shipping logistics, exchange rules, contract specifications, and capital controls may all play a role in slowing the process. At the same time, demand for physical silver in Asia appears to have surged. Industrial buyers, refiners, and investors in the region may be competing for available metal supplies, pushing local prices upward. Meanwhile, Western financial markets continue trading silver largely through paper derivatives rather than physical metal. The result is a strange situation where two major financial centers are sending completely different signals about the value of the same commodity. To understand the deeper cause of this price gap, we have to examine how the silver market is structured. Most global silver trading does not involve physical metal at all. Instead, it takes place through futures contracts that allow traders to speculate on price movements without taking delivery of the metal. The COMEX exchange in New York is the largest hub for this kind of trading. On many days, the amount of silver represented by paper futures contracts traded on COMEX exceeds the actual physical silver available in exchange warehouses by a wide margin. This system works as long as most participants settle their contracts financially, rather than requesting delivery of metal. In contrast, markets like the Shanghai Futures Exchange have a stronger link between contracts and physical demand. Industrial users in China often rely on these markets to secure actual metal supplies for manufacturing. When demand increases in those sectors, the effect shows up more directly in local prices. If physical demand grows faster than supply, the premium in the physical market rises. That appears to be what may be happening now. Global silver production has not been expanding rapidly, while industrial demand from solar energy and electronics continues to increase. At the same time, large financial institutions still dominate futures trading in Western markets, where prices can be influenced by algorithmic trading strategies, hedging activity, and macroeconomic speculation. When these two systems move out of sync, the result can be a pricing disconnect between paper markets and physical markets. When commodity markets become distorted, the consequences are rarely limited to traders or investors. Real businesses and workers can be affected in significant ways. For manufacturers that rely heavily on silver, unpredictable pricing can create serious operational challenges. Solar panel producers, electronics manufacturers, and medical equipment companies all depend on stable silver supply to maintain production schedules. If the physical price of silver begins rising sharply while futures prices lag behind, companies may struggle to secure metal at the prices they expected. That can increase production costs and reduce profit margins across entire industries. Smaller manufacturers are particularly vulnerable because they often lack the financial resources to hedge their metal purchases effectively. In extreme situations, supply disruptions could even delay manufacturing output, slowing production in sectors that are already under pressure from global supply chain challenges. Investors and savers may also feel the impact indirectly. Precious metals markets often reflect broader economic stress. When physical metal becomes harder to obtain, retail investors sometimes begin purchasing coins and bars more aggressively, creating shortages in local markets. This can lead to higher premiums for retail buyers, meaning individuals may pay significantly more than the official market price to obtain physical silver. In the past, similar situations have triggered waves of panic buying as investors try to secure tangible assets during periods of financial uncertainty. One factor that may be intensifying the silver market imbalance is the changing global monetary environment. Over the past few years, central banks around the world have aggressively raised interest rates in an effort to control inflation. Higher interest rates typically reduce demand for precious metals because investors can earn yields from bonds and other financial instruments. However, financial markets are beginning to anticipate that the era of high interest rates may not last indefinitely. If economic growth slows, or if financial instability emerges, central banks could eventually be forced to cut rates again. Historically, periods of monetary easing tend to support higher prices for precious metals. Investors often view metals like gold and silver as protection against currency debasement and inflation. As a result, even the expectation of future policy changes can begin shifting investor behavior. In addition, global debt levels remain historically high, creating long-term concerns about the sustainability of government finances. When debt burdens become large relative to economic output, central banks may face pressure to keep interest rates lower than inflation. That environment tends to favor hard assets over financial assets. Another factor that could be influencing the silver market is the ongoing transformation of global supply chains. Over the past decade, geopolitical tensions and trade conflicts have begun reshaping the way countries secure strategic resources. Metals like silver, copper, and rare earth elements are increasingly viewed as critical materials for technological development and national security. China plays a dominant role in many parts of the global manufacturing ecosystem, and its demand for industrial metals can have a powerful influence on global prices. If Chinese industrial demand for silver increases significantly, the impact may appear first in regional markets like Shanghai, before spreading globally. At the same time, Western financial markets may initially react more slowly because they are influenced by macroeconomic sentiment, currency fluctuations, and speculative trading. This difference in market behavior can create temporary divergences between prices in Asia and prices in Western exchanges. Additionally, logistical challenges such as shipping delays, refining bottlenecks, and transportation costs can limit how quickly physical metal moves between regions. Even in a highly interconnected global economy, physical commodities still require time and infrastructure to move from one market to another. When commodity markets experience persistent price distortions, the implications can extend beyond individual industries and affect national economic strategies. Silver plays a vital role in renewable energy technologies, particularly solar power. As governments around the world invest heavily in clean energy infrastructure, demand for silver and photovoltaic systems continues to grow. If silver supply becomes constrained or prices rise dramatically, it could influence the cost structure of renewable energy projects. Countries pursuing aggressive energy transition policies may find that key materials like silver become strategic resources requiring careful management. In addition, precious metals markets often serve as indicators of investor confidence in financial systems. When metals begin behaving unpredictably, it can signal underlying stress within global financial architecture. Governments and central banks monitor these markets closely, because sudden price movements in commodities can affect currency stability, trade balances, and investment flows. A persistent divergence between Asian and Western commodity prices might also reflect shifting economic influence within the global system. The most important lesson from the current silver price gap is that markets occasionally reveal deeper structural changes long before they become obvious to the wider public. A $14 difference between two major commodity exchanges is not a normal event. It suggests that the mechanisms linking global markets may be under pressure. That pressure could come from rising industrial demand, shifting geopolitical dynamics, monetary uncertainty, or structural differences between financial derivatives markets and physical commodity markets. Eventually, the gap between Shanghai and New York will close. Markets rarely tolerate large pricing inconsistencies indefinitely, but the key question is how that adjustment will occur. Either physical prices in Asia will fall back toward Western futures prices, or the global benchmark price of silver will move higher to reflect stronger physical demand. Investors who follow commodity markets closely understand that moments like this often occur near turning points. When physical markets begin sending signals that differ from financial markets, it can indicate that supply and demand conditions are changing beneath the surface. Whether this leads to a temporary correction or the beginning of a larger precious metals cycle remains uncertain. But one thing is clear: the silver market is currently sending a signal that deserves careful attention.